Our third speaker is Mick Golden. Mick has, again, considerable experience in commodity trading in both the finance end of it, and also he's got a background going back some time in farm operations in the central west of New South Wales. So to give us his perspective on trade finance and what's happening in the market, please welcome Mick Golden.
Thank you, Mick, and thank you very much to the AFI. I'm enjoying being here. I've found the topics and the panel discussions to date exceptionally informative, and also they hold a lot of currency in the market at the moment, and in this market environment. I've enjoyed the talks about people, how they're converting their commodities into product to make better connection with the marketplace, the great work that DFAT and Austrade are doing to help open access has been fantastic. Along with some of the past work done in deregulating markets both onshore and offshore, this is really allowing capital flows to come into the market, or at least the point of the supply chain where people want to interact. So it really creates a great opportunity. Effectively, we've got a bunch of enablers, be it producers, exporters, or importers and consumers responding to market signals, that being the supply and the demand. I sometimes question whether the market's found us or we've found it, but after listening to everyone in the last day or so, I get the impression that everyone's done a lot of great work to help connect Australia with various markets. And in any trade that you do, doesn't matter which point, and everyone's sort of ducking around, moving away from being a transactional or a spot transaction, there is a trade. You have to negotiate the terms of the trade, whether it be what destination, what quality, what quantity, what delivery period, and all of that sort of stuff. Along with that goes all the legal and the contracting type terms, the funding and the FX. So yeah, we've been asked to talk a little bit about the funding side of it. Hopefully I get the technology right here. My background originally was in broking and trading, so business to business type deals, funding commodities, and also managing price risk and supply risk for various people. The markets that I have expertise in largely, or that I've come across largely, are usually what I would call the hedgeable markets, or the bulk commodity markets: wheat, sugar, cotton, there's canola there. And nearly in all instances, the buyer and the seller want to do business. You know they want to get together, but funnily enough, the seller wants to sell on their terms when the price is right for them, and the buyer wants to buy on their terms when the price is right for them. So over my career, I've spent a bit of time putting together, I suppose what you call them, long-term supply contracts, or even just supply contracts, when a lot of the contracts were based off what we call basis contracts, because a lot of the commodities that we produce here in Australia, there's a benchmark market, whether it be futures or some sort of index like that. The buyer and seller willingly want to get together. The buyer wants to buy the product from the seller. The seller's got known quality, or they just store it right, they do it right, or they might follow that Better Cotton initiative and things like that. So it's probably not a new concept to quite a few of you, but I just share with it, this is how people often get together. They get together trading their basis or their premium off a benchmark price. And quite often what the futures markets have done in the past, they're basically a point of price consensus, where all the buyers and sellers go together and come up with what they think the price is on the day. Could be right, could be wrong. Quite often in those markets, you're a rooster one day and the feather duster the next. But it also allows the participants in the supply chain to decide where they want to engage. Traditionally, a lot of SMEs or producers want to engage in the ex-store or free in-store market, so they might trade. These numbers are just loosely, off of wheat futures, but I'll use it for example. So when you're trading interior Australia, they'll agree to sell at $30 under the benchmark, and that $30 hopefully will represent some sort of value of, can they store it right, have they got the quality right, and whatnot. People who know how to do logistics but don't want to go to destination markets, well, they'll just deal in free alongside ship, delivered container terminal or FOB, and there'll be a slightly different price. They might be dealing at plus 10. But everyone's talking the same language. They're saying, yes, I want to deal with you, I want to do with you, but today I actually don't want to price it, I just want to lock in the supply. And you just move up the supply chain. If you've got freight and great connections at destination, you're going to go into the CFR or the CIF market. And equally, if you're happy to go right into destination, well, you're doing, delivered duty paid or delivered at point type pricing. And those costs, the numbers don't mean anything there, but they're just a rough guide as to what might be the differences. And in that, you get your benefit for your quality, the relationship, maybe whatever else you bring, and a little bit of margin, or what the Canadians call tookage, how much you took. It's a great word, isn't it? So some of the experiences I've had there, I've put them together for specialty wheat, for irrigators with flour millers and biscuit makers. We've done this for the users of flour and their flour millers. Done it for the chicken meat industry, particularly those guys have had a fair bit of pressure on them from supermarkets to supply them with long-term, chicken meat at certain prices. The dollar bread at Woolies and that sort of stuff. If someone's going to commit to sell flour at whatever that is to meet that, they've got to have the ability to both lock in supply and price. But tell me which farmer or producer wants to sell their flour at those prices. Not very many. Largely that's what I've done is look after price and supply risk. The group of people in that market are diverse, it's at times fragmented, and like I said, they all want to deal with each other. So the concept of basis market or premium over and above a benchmark for the markets that have got some sort of global price discovery works quite well. At the end of the day, once you've put the deal together, you've still got to fund it. So the sort of stuff that Karen and Adam were talking about is very much applicable. The post-shipment phase, or once it's on a boat and floating to destination, is very well serviced via LCs and things like that, and the work that EFIC and those guys do. The bit that has been a challenge, I think, in obviously Australia at least meeting the demands for both the international market and domestically, is getting enough money into the pre-shipment phase. And if you're a trader of these commodities, or even a producer moving up the supply chain, or equally, there's quite a lot of consumers and importers moving down the supply chain, you've got to tie a lot of money up in the funding of the inventory, which gives you a pretty poor return. It knocks your balance sheet around in that. It really came to the fore in around about 2008, and I won't go too far back in the past, but we'd move forward. But that was when the AWB was about to be deregulated, and traditionally the AWB was the major buyer and funder of the Australian crop. They ran a pooling system, advanced about 70 or 80% of the value of the price to the farmers, which funnily enough might just happen to equal the LVR they got from their financial institution. Just could be a factor, I don't know. And prudent risk management, I'd say. That same time, if you remember, we'd just come off a drought year, and equally global prices for wheat and other grains were going through the roof. They were rallying. The highest price before that was around 96, 97 at 750 cents a bushel. Went all the way to 13.50, and it went fast. So there was something else going on. There was a lot of new players coming into the market trying to buy wheat from producers ahead of the exports, and they wanted a brand, and they wanted a piece of that 10 to 15 million tonne supply market the AWB had. And equally, they were showing strong prices. The farmers were loving it. Yep, I'll sell. They were putting it in their budgets and showing it to their bank managers, be it any one of the banks. The bank managers were going, what? You're going to get $300 for your wheat? Yeah, and you could see the price, no problem at all. I had a drought last year, so could you spot me for another year? And the bank managers were concerned that if the AWB's not there, who's going to damn well pay them at the end of the day, and will they be strong enough? Equally, I work in the market. At that time, I was working in the markets part of CBA, and we were taking a lot of the hedges that these guys hold, the merchants hold. They typically buy from the farmer and then will sell on a futures market or sell to a financial institution, a swap, fund what they call margin. And the poor old merchants were being smashed too. They've got a short position. The market keeps going up. If you're in the futures market, you've got to make good that every day. So they're having to buy the crop before they even got it. When we're talking these prices, they went to $500 a tonne. So at the end of the day, I got called in by John Sutton, who was then the general manager of the agri business, and he said, look, here's the problem. My farmers are showing these high budgets. Are they achievable? They sure are. Are they going to get it? Yeah. What about all these new players, names that we may not have heard of in agriculture, Glencore, can you trust them? Olam, Louis Dreyfus. They're all respectable companies, but people just weren't sure who they were. And it took me back to the time that I spent in the US. So we had a problem. Could we actually fund the crop and allow everyone to get onto it? Moving forward though, actually going back, I went and worked in the US cooperative system in 2005 because that was a deregulated market, highly consolidated and very well functioning. And apart from learning a few insights there, it really sort of said to me where Australia will be in at least those markets in 10 years' time. But the take-home lesson I got when I came back is if you're a country merchant or an exporter trying to engage those markets, even though it was a highly consolidated market, fairly few players, very well contestable, you could get 100% funding for your inventory and another 10% to run your hedge book, because that's what you needed. And that didn't occur in Australia. So going back to John Sutton's problem, I said, well, actually, why don't we just adopt cash and carry? And thanks very much for mentioning it earlier there, Andrew. The concept of cash and carry is not new to traders. It just hadn't been done in financial institutions in Australia. And largely what you do is, along the lines of those ownership-based facilities, you just buy the inventory at market price from the merchant who's supporting the producer, and you hold it and you give it back to them later. Whether it's a repo structure or a hedge on top of it, that's your choice. Andrew covered what you need to do in any ownership-based structure. You need to be able to value the inventory, insure it. Can you sell it if the guy who you're holding it for doesn't come back, or the guy or the girl come back? And can you account for the inventory? Well, in Australia, a lot of the commodity markets, be it sugar, cotton, wool and grain, they've got well-established supply chains, they've good methods of accounting for them in the bulk handling systems and that. So you could actually hold it, capture it and go for it from there. And once you can monetise the asset, particularly if it's deep enough and liquid enough, yes, yeah, then you can put more funding into it. And that was the approach that we took there. It's slightly different. So, and a bit like the ownership-based stuff, is the bank will hold and own the asset. Assume the risks that go with it, so become an operational risk and hopefully fit in with the systems that a lot of these trade houses were doing. Our school of thought was the post-shipment phase, or once it's on a boat's well covered, and Andrew covered that. But if we could make the first buyer stronger, then they could at least pass on the right price signals to the producer. And you've got to remember though, the producer wants to sell when it's high. Quite often the producer didn't want to sell when it's low. The buyers want to buy when it's low. So if you can link them together with some basis contracts or premium contracts, and then allow each of them to go to the futures market when they choose, quite often you've got a supply chain where you've matched people together. They're not fighting each other in an arm wrestle for price, but they're letting the market do the work. So that was the motives for doing it, and it worked quite well. Initially, we tried out with about $20 million the first year, 200 the second, and then the third year we had to go and get board approval because we were going to start holding more grain than gold, so which is interesting for a bank. The benefits were along the lines of what Adam talked about. You can free up cash flow. There is also some unforeseen benefits that we didn't realise. You're helping people manage their balance sheet, but go ask your auditor for that advice, because we can't give it to you. And along the lines of what Adam was talking about, when you put a financial institution in the supply chain, they're not trading it or moving it, you're just funding the asset. All of a sudden you've lifted the counterparty credit risk. So that were some of the benefits that came out of it. Anyway, I will move on and go off-piste a little bit, stop talking about just funding commodities and whatnot. But before I do, the major message that nearly every commodity business talked about is, yes, they wanted to get a premium, they thought they had better quality, or the buyer wanted to know with certainty, the identity path that that grain or that commodity, that cotton came along, and that was the key message that we saw yesterday. But they still wanted to do business with each other on their own terms and at a time of their choosing. Some of the changes that I think are going to happen in the commodity space, or agricultural trade in Australia, we're starting to see peer-to-peer lending pop up. I'll just pick an example, and these companies are happy enough for me to mention their name. Society One has basically got a peer-to-peer platform lending system where they find investors who want to put money into a market, they do a credit check, and then they've also got borrowers. Society One do this for cattle. They do it through an agency network. What happens is you go out and buy the cattle of your choice from wherever. They'll pay 100% of that money. The agent takes the first 10% hit. But instead of getting your funding from a financial institution, the investor who put the money in is on the hook. If your cattle go down and you don't pay it off, the investor takes the hit. Obviously, there's a yield return for these guys, so you're not going to get this money for under 10%. But it's just new sources of funding, and that might allow producers to build a better set of cattle yards or comply with whatever requirements are needed to meet supply chain needs. Co-investment, this one's very topical in dairy. There's a lot of people who want to be in dairy. There's a lot of investment that needs to go into dairy, buying a bigger farm, building a better rotary or milking systems. So a company called Cowbank that traditionally has been leasing cattle or helping producers lease cattle have got into co-investment. They've now found investors who want to be in that space. the investor, the investor wants to be in the space, but they don't want to manage it. Slightly different model to funds just buying outright and operating on their own. They partner up with someone with the skill, and these guys, the person with the skill might be a young entrepreneurial type who's got skill in dairy. They go in for 5%, the investor comes in for 95%. Over the course of time, the farmer or the guy with the skill is allowed to buy up to 20% at the original purchase price. The investor stays with them for 8 years, and in 8 years, probably they'll put the farm, an asset, to the market to get their return. Instead of taking a yield, what they do is they just take a percentage of the cash flow. Not really different, but just new sources of funding to try and meet some of the demands that are required to help, really build the infrastructure to deliver that. Major financial institutions will continue to be the major source of funding. I don't see any reason why that'll change. And some of these other alternatives that are popping in, it is basically, I won't call them bit players, but are meeting a genuine need, and they're getting some traction. A lot of innovation is happening in this space, and agriculture is a 21st century business. It's pretty exciting to be in. And the last point, if I just got to go off-piste a little bit, again sticking with commodities, funding is just one part of it. Obviously you need all the entrepreneurship that we've seen people demonstrate here. Buyers genuinely want to get together and do business. But for markets that are commoditised, where you are trying to extract a premium, the one thing that does appear to be missing in Australia is a deep hedgeable market, like a futures market. It really only got one, and that's grains at the moment, and it trades percentages of its volume. Whereas you go and look at the New York cotton market and the sugar market and the US wheat and corn markets, they trade multiples of. And right now we're taking our price signals from another point. It'd be awfully good if you could have a market here. Now, I know some businesses, or ASX is trying to do that, but it just hasn't taken off yet, and I'm not quite sure why, but I'd love to see some forward markets or exchange-traded forward markets in Australia, be it in dairy, be it in beef, and be it in grains, particularly then, because then we could have people coming to these Australian hedge markets to get their point of price discovery, and then let each other person in the supply chain work out the arm wrestle of what value or premium they get over and above that market. Okay, thank you for your time.